Hey everyone, welcome to this week's Fundamentals Unfiltered podcast. I'm Matt with the Fundamental Investing Institute. We are recording this on December 30th, 2025. Hey everyone, so I wanted to, I was going to do like a year ahead kind of thing, but then I remembered how much I hate that. Every year in late December, early January, you've got a lot of financial institutions, investment firms, and so forth will do these seminars, or they'll do webinars, or they'll put out different material on their website about the year ahead. And of course, no one has a crystal ball, not even the very smart people at a lot of these financial institutions. It just so happens that I went to one in 2008 and I went to one in 2020. So this was really highlighted for me as to how little people know about what the next year is going to hold. And of course, I remember the one in 2008 where it was like, I won't mention the firm, but it was a major one of the major national brokerage firms, and it was someone I knew that was given the seminar, so it was just kind of a butt in the seat at the time. But I remember him talking and saying, "Well, our strategists are predicting a 30% chance of a mild recession." And of course, by the end of 2008, we were staring down a financial crisis that rivaled the economic crisis of the 1930s. And then in 2020, if I remember correctly, it was another major national brokerage, and they were talking about things that just became completely irrelevant a few months later. And there was not a single mention of the virus that was starting to hit China and whether that would hit. I mean, it just wasn't on anybody's mind, but it can kind of show you how we can very often have major exogenous events that no one is foreseeing. So the point is, I don't know what 2026 is going to hold. Rather, I wanted to kind of talk about some of the big themes in 2025. Some I think are worth talking about in depth, some are worth just kind of mentioning, but we'll see what we can cover. The first I want to talk about was the gold and silver rally. This is very interesting. So, one of the reasons why I follow gold specifically, because of course I'm an investor, I buy stocks, invest in commercial real estate interests, sometimes private business interests. I don't really do anything with commodities, but I pay a lot of attention to gold and gold prices because it's really a barometer of sentiment, specifically about the dollar, arguably about fiat currencies in other markets as well. And gold is, as of yesterday, and keep in mind we've got today and tomorrow as well to see what gold actually does for the full year. But year to date, as of this morning, which would have been yesterday's closing price, gold was up about 65%. So from January 1st through December 29th, 65% for gold. The other interesting thing, and I haven't talked about this much, is silver prices, which you would think would be relatively in lockstep if they're trading on the same issues, that is, as alternative sources of value. But silver's actually up about 150% over that year-to-date period, and we'll see how it closes the year. So unless there's some big reversal or another big shift to the upside, it's about 150% on the year, 1.5 times where it was at the beginning of the year, and that's staggering to me. Now, one of the things that's interesting is because silver on a per ounce basis sells at so much less than gold on a per ounce basis, very often people will hold physical silver, whereas they won't necessarily hold large amounts of physical gold. So I don't know the answer to this, but my guess is a big part of the silver buying is actually physical silver and not just futures contracts and ETFs and a lot of things. Now, what was happening with gold at the beginning of the year was you had a lot of central banks that were buying this, partially to divest of the dollar. Um, but I think by the middle of the year or so, it seemed like gold was very much becoming a momentum trade. And I would definitely say silver is becoming a momentum trade as well. One of the things that's important and why I bring that up is, of course, momentum trades can unwind very quickly. So you can have momentum to the upside, you can have a lot of momentum to the downside. So anyone that's in this market thinking that gold and silver are going to go up, and they may be right, just they have to be aware of that. Now, I've got a lot of friends that are Bitcoin enthusiasts. I don't own Bitcoin for the same reasons that I don't own any other commodity. I think it's probably appropriate to see it as kind of a digital commodity, but the argument that Bitcoin is an alternative store of value, much like gold and silver, if we look at Bitcoin prices year to date, again over that same period, down almost 6%. So gold up 65% roughly, silver up 150% roughly, Bitcoin over that same period of time down almost 6%. So just based on this year, I don't know where you can fit Bitcoin into that narrative of digital assets as an alternative source of value. To me, you still have to have at least a few years underneath us, and then maybe we'll see if Bitcoin becomes an important market to follow for the same reason that I follow gold and silver, namely because of what it's saying about fiat currencies and namely the dollar. But that said, certainly a commodity being up, 65% in the case of gold, 150% in the case of silver, those are big. Those are big news sources, and I would be very surprised if those two commodities have a great 2026. But again, I don't like to make predictions, so take that with a grain of salt. Another issue that we had this past year is there was a lot of talk about things that were going on in private markets, and the reason why this is so important for retail investors is there's now a big push, of course, to allow retail investors to invest in private funds. And it's an important point for different reasons, but the president signed, I think it was back in August, it was an executive order sort of directing the Labor Department to create some rules that would allow private investors to use their 401ks and I assume 403bs and other similar account types, that they would allow these retail investors to invest in these individual private funds. And it's important to know that we're talking about private funds and not necessarily individual private assets. So something that I'm a big believer in is something called the Jobs Act. It was passed in 2012, and it's had kind of mixed results. But the Jobs Act allowed individual investors to invest in private markets to a certain degree. But what we're talking about with this big change about 401ks is these are massive investment funds. So they're not going to be the same kind of investment opportunities that you'd have with the Jobs Act. I'm very skeptical about whether this is good for retail investors. One of the things that's happening in private equity right now is there's a major liquidity issue where they're having a lot of trouble selling assets. So private equity firms have been lobbying for a number of years to try to tap into new funding sources. So to me, it's a very cynical way of viewing things, but it looks like a transfer of risk from sophisticated investors to maybe not so sophisticated investors. And we're going to pay a lot of attention to how this is marketed, but my guess is that there's probably going to be way too much optimism among a lot of the participants in this, and maybe for the wrong reason. Unfortunately, the investment world is riddled with incentives that don't always work in the favor of the individual investors or the clients. And I would not think that this would be any different. Now, there's a couple of articles, I'll probably talk more about this in some subsequent videos, about there was a real estate fund that went from being a a private fund to a public fund, and net asset value, which is the market value of the assets minus liabilities. When a fund is private, the net asset value is essentially an estimate from the firm itself. And now that this fund is public, I haven't looked at the recent trading information, but as of maybe a week or so ago, the public market was placing about 65% of their estimate. So the public market cap was about 65% of what they were saying the NAV was. And of course, it's a question of who's right, but it does sort of highlight how maybe some of these private funds are overstating NAV. It's just another risk that investors need to think about, especially if they start to buy into these private funds via their 401ks or any other account type. So that's definitely another thing that is probably going to carry on to 2026. It's been a big issue in 2025. The other issue is the Federal Reserve. We're getting a new Fed chair in May, and there's been a ton of drama this year. Most of it's been background noise. I've come to appreciate over the years there's a big difference between rhetoric and what politicians and political talking heads say, and then what the market is actually incorporating. So you haven't seen a lot of yield premium in bond yields. You haven't seen a lot of risk premiums that would reflect a big risk of the Fed becoming less independent. But with a new Fed chief coming in, a new chairman of the Federal Reserve that's going to be coming in May, and the president has said that he wants that person to consult with him, the president, on interest rates, is a really bad idea. The independence of the Fed is very important. And if that happens, my guess is you're going to see risk premiums spike on longer term bond yields, which of course could be higher mortgage rates, could be higher business borrowing rates. A point that I've said many times before, the Federal Reserve does not have direct control over mortgage rates and business borrowing rates. The base rate for those interest rates is the 10-year bond yield, which the Fed can influence but does not have direct control over. And the federal funds rate, which is the overnight borrowing rate that the Federal Reserve sets, they can artificially push that down all they want. It's not necessarily going to push down longer term bond yields. If the market starts to see higher inflation, if inflation expectations go up because they think that the Fed is running a too loose monetary policy, it could very well have the opposite effect, which is higher longer term bond yields. So that is another risk, major risk going into 2026, but it's certainly something that's been a big theme in 2025, but it hasn't really held yet. The president has said he wants the federal funds rate at 1%, and I'll just bring up something, and that is what the market is telling us about where the federal funds rate would be in the near term, in the near future. So what you want to look at is the 2-year, and the reason the 2 years is so important is whenever you invest over a period of time, you can think about that as a series of short-term interest rates. So you just buy in the short term, roll that over into another short-term instrument. So the 2 years is essentially a prediction of the direction of future short-term interest rates. And right now, the 2-year is about 3.5%, which is roughly in line with the federal funds rate. So the 2-year bond yield, the Treasury market is not predicting a sharp drop in short-term interest rates. So I'll just bring that up. That said, we'll see how things go in the new year. Hopefully, um, if there is any kind of big bond sell off, whatever forces are driving that on the political side, hopefully they dissipate. Um, this president does have a tendency to react to markets, which I think is generally a good thing. Finally, I haven't talked about this much on this show, but of course, in public equity markets, the big issue is the so-called AI bubble, and I'll just say I don't like that term. To me, a bubble is when valuations in an entire sector of the economy or an entire segment of asset markets, be that real estate assets or publicly traded stocks or whatever, it's when that entire sector becomes massively overvalued. And the reason I don't like the bubble talk in the case of AI is a lot of companies that I've looked at are still great underlying. They still have great underlying businesses. I mean, Nvidia, you could argue it's about a $4.5 trillion market cap now. You could argue that their P ratios may be a little bit high. There's a lot of competition coming in, but there's still a big underlying business there. And Google is another company. In fact, my biggest investment mistake, just to give a mea culpa for the year, my biggest investment mistake is I started looking at Google over the summer, late spring, early summer. It's roughly doubled since then. And I looked at it because they have a great core business in search. And you were basically getting anything they did on AI for free. Free cash flow yield of Google at the time was, if I remember correctly, was about 7%, which is a very attractive free cash flow yield if you look at their earnings potential. So you were getting their existing business at about a 7% yield, and then you were getting anything that they would do in AI basically for free. For a lot of different reasons, I didn't buy it, and it's my biggest investment regret for the year. So, just in the interest of, disclosure. But coming back to what I was saying is a lot of these companies still have great underlying businesses. Even Oracle, which went through this massive sell-off recently after the big valuation spike early in the year, they have a great enterprise software business. They have a strong cloud business. I own some shares in Oracle. I wasn't even really thinking about what they might do on the AI front. And that's very different from what we saw in the late 90s. Having lived through that, two companies that I can think of from that period that have been kind of the poster boys for the dot-com bubble, the late 90s, early 2000s. One was Pets.com and the other was eToys. Both companies, went away, and they both had multi-billion-dollar valuations at one point. In both cases, neither company ever made any money, and neither company could really articulate how they were going to make money in the future. So it was just a completely nonsensical valuation. So to come back to how we think about valuations, one thing you have to ask if you're an investor is, how much am I getting for what I'm paying? In other words, you got to look at the value that you get relative to what you're paying. What you're paying is the market price, and the value that you're getting is the future earnings of the company, the future cash flows of the company. So whether something is overvalued or undervalued or fairly valued, the question is always about, am I getting future earnings or future cash flows that can justify the current market price? In a lot of cases, the answer is yes. I do see tremendous signs of excess on the AI front. I'd say the biggest signs of excess that I see are mostly companies that are still private, which actually raises another interesting issue. But OpenAI is a good example of this. I read that it recently had a funding round. I think it was valuing the company at 850 billion, somewhere around there. Now, from a valuation standpoint, I think the company is generating less than 20 billion in revenue. And so it's hard to see where OpenAI is in the next 5 years, 10 years, to where they can justify an almost $1 trillion valuation. Lots of other private companies that are getting venture capital money and these companies are being valued in the tens of billions or hundreds of billions of dollars, and they're not yet proven business models. It's all just kind of hope about they have these AI driven business models and they'll produce lots in the future. So on that front, there are going to be winners and losers. One thing we have to understand is the venture capital model kind of requires venture capital firms to go out and invest in a lot of things. Most of those things are going to be bust, and then they're going to make a lot of money on just a few ideas. That's just the way the venture capital model works, and it's something to keep in mind, especially as retail investors start putting money into these, whether they're venture capital funds or maybe leverage buyout funds. I don't know what kind of private assets are going to be marketed to retail investors, but that's something to keep in mind. And it also brings up the point about how much capital markets have changed in the last 15 years, because it would have really been unheard of for a company to reach this massive of a valuation before it went public. And so one of the things that's happening is companies are staying private for much longer. And this is kind of denying a lot of retail investors the ability to invest in high growth companies. So I think that's going to be another argument for letting retail investors in, but they're not investing in individual businesses. They're investing in funds, and the funds are going to have a lot of duds. And my guess, on average, a lot of these funds are probably not going to perform as well as the S&P, which is kind of the benchmark for any kind of risk asset. So that's going to be a huge issue coming forward. But again, I'm not sure that the whole bubble talk is really appropriate. I know Andrew Ross Sorkin is a financial journalist. He wrote a book on 1929. It's a great book. I've read mostly through it. And he's on these shows and he's promoting the book, and he's being asked about parallels between the 1929 bubble and the conditions of today. And he's pointing to a lot of this stuff, rightfully so. But I still think you have a lot of strong, legitimate companies. Maybe they're selling at a little bit of a high valuation, but I don't know if the term bubble is necessarily appropriate. That said, there's a lot of excess here, no question about it. There's a lot of companies that are not going to be able to earn enough to justify their current valuations. So if you're an investor, valuation discipline, price discipline is everything. Not getting caught up in kind of the fear of missing out mentality, which gets a lot of investors in trouble. But if you're willing to do that, I think there's still going to be opportunities here. Just keep your eyes open. So finally, we'll talk a little bit about our plans at the FII for the new year. We have our website, fundamentalinvestinginstitute.com. We have a ton of free material out there. I did a blog series earlier in the year on money and banking. I did one on commercial real estate. I just finished a blog series. I think we're launching the last one this week on the major stock indices. So the S&P 500, the Dow Jones Industrial Average, the NASDAQ Composite, and the Russell 2000. I did a write-up on each one of those indices. We're going to be continuing to post new information, new content, educational content on that website, all sorts of things. And we've also launched a Substack, and what I'm doing with the Substack, we're calling it the Thoughtful Investing Project. And what we're doing with the Substack is we are documenting the whole research process of creating some of the courses, but also we're really trying to create a whole kind of self-learning community, so self-learning environment. So, for example, right now I'm doing a deep dive into the global economy, global economics study project that I'm calling it, and I'm going through about 30 books, some supplementary material, but every week I'm writing an essay on what I'm learning through that material, and I'm going to be doing that. And then once that project is done, I'm going to be following that up with a deep dive in international finance. But it's a lot of educational content that we're putting out there. Hope you guys can follow it. And I want to wish everybody the best new year, best of luck in your investing endeavors. And as always, focus on the fundamentals.